Imagine you've been incredibly disciplined. You finally save up $10,000 in your bank account, only to check your balance a whole year later and realize that at a 0.5% interest rate, you've earned exactly $50. It's frustrating to feel like you're doing everything right by saving, while it seems like everyone else is increasing their net worth through stocks and compound growth. The math shows that saving alone rarely builds significant wealth. The most significant financial divide isn't between those who spend and those who save. It's between those who save and those who invest. To bridge that gap, we've developed a 5-step blueprint to help you transition into an investor without compromising your financial security. Mastering this transition is the foundational requirement for building a net worth that eventually grows independently of your daily labor. Step 1 is a mandatory safety requirement. Calculate 3 to 6 months of your bare-bones living expenses and move that exact amount into a cash reserve before investing a single dollar. This emergency fund is strictly for catastrophic events, like a job loss or a medical emergency. By having this cash ready, you ensure you'll never be forced to sell your investments during a market downturn just to pay your rent. Step 2 involves adopting the 2-bucket mental model to help manage the psychology of money. Savings feel secure because the balance is static. Investing, however, introduces price fluctuations that can be emotionally difficult for beginners to watch. Think of saving money like storing seeds in a glass jar. They are safe, but they will never change. Investing is like planting those seeds in soil. It looks messy at first, but allows the seeds to actually grow into something larger. Under this model, your safety money stays perfectly still to protect you, while your growth money is given explicit permission to fluctuate in the market because its specific job is long-term expansion. Mentally partitioning your finances this way creates a defense against the anxiety that often leads to investment paralysis. Step 3 is making an initial micro-investment of just $50 to $100. By starting with such a small amount, the goal isn't immediate profit, but rather building the habit and overcoming the natural fear associated with the buy button. Step 4 is choosing a strategy that is intentionally simple and boring. This means avoiding high-risk, complex trends like day trading or crypto speculation. Instead, look toward broad market index funds, which provide diversification by tracking hundreds of companies at once. Even legendary investor Warren Buffett consistently recommends low-cost index funds for the vast majority of people. To see why this matters, look at a $10,000 balance over 20 years. At a 1% savings yield, that money only grows to $12,200. However, the S&P 500 index has historically returned an average of about 10% per year. At that rate, the same $10,000 would grow to roughly $67,000 over those 2 decades. Choosing a diversified asset class allows time to become the most powerful multiplier in your financial life. Step 5 is the automation of the entire process so that your growth doesn't depend on your willpower. Set up a recurring monthly transfer from your checking account directly into your chosen index fund so the contribution happens without you thinking about it. Consider this scenario: investing $300 a month at an 8% average return over 25 years. Your total out-of-pocket contribution would be $90,000. But the final result is nearly $285,000. This means nearly $195,000 of that wealth was generated purely by compound growth. Automation removes the risk of human error or emotional decision-making, allowing compound interest to work relentlessly in your favor for decades. You have a safety net, mentally separated accounts, and an automated system designed for long-term growth. Even with this system in place, it's natural to worry about what happens when the stock market inevitably drops or crashes. For an automated investor, market downturns are actually a mechanical advantage. Your fixed monthly investment simply buys more shares at lower prices, which can lead to stronger returns when the market eventually recovers. Success requires a shift in perspective. A novice might panic over a bad week, but an experienced investor focuses on the trajectory of decades. Saving money provides the foundation of your stability, but investing builds the actual structure of your future. Start that process by making your first $50 transfer today.